Thanks, Mark.
Excellent, yeah, thanks Mark. Great introduction as usual. Should we kick off with the first slide, Marcus?
It's called the book.
It's the obligatory Warren Buffett quote. We love Buffett quotes, Charlie Munger. A lot of what we've learnt in the past has come from reading about them and how they invest. And I think this one is really key in what we do. And one of our key tenets and key competitive advantages is our patience. And just thinking about that, we often own companies for a long time. Hopefully forever in some cases when they're really good, as Buffett and Munger would say. It's that patience I think that holds us apart from the rest. We don't get caught up in the noise, the short-termism of markets. I mean, you've got brokers out there with timeframes of 1 month, 3 months, 2 months. You've got some clients pushing for short-term returns. You've got consultants pushing as well. It's hard to push back on that. And even we become short-term in circumstances. And that's something it's hard to control. I mean, I think we're human, and that's something that is very difficult to control. So patience is critical. I think discipline is also critical, investing in equities generally, and particularly in small caps. But we will talk about the noise, and Marcus will talk about reporting season next, because we have to. It's part of the story.
Okay. Thanks, Matt. So, part of the presentation today is about reporting season and what we learned from reporting season in small cap space. And I think one of the topics du jour is obviously inflation. We've had a lot of questions around wage pressure and goods pressure. If you go back about 18 months to 2 years, I think there's a lot of pressure on goods. We had COVID exacerbating demand for many things, from freight right through to computer chips. Who's ever heard of a shortage in computer chips? I've never even heard of those being in short supply before. They're pumped out in great supply out of Taiwan, but even they were in short supply, and that saw a massive increase in transport costs, in factory production costs out of China, etc. And eventually that started flowing through to inflation numbers. And I guess it was only a matter of time before wage pressure was evident, and we're starting to see it now in Australia and around the world. The results, I think wage pressure was something that I think I'd call out as being a major theme or a major issue. Not only wage pressure, but actually staff availability has been another major problem for companies, not just in the cities where it's hard for cafe workers to find cafe employees, but even mining service companies and even on the farm, they're finding a hard time to get labour. So it's become a major issue. But I think we would argue that inflation is somewhat abating. There's some signs that at least on the good side, prices are coming down, and transport costs have come down a lot. So it used to cost something like roughly $1,000 to get a container of goods from China down to Australia. That rose as high as $12,000 during the peak of the crisis. It's back down to $1,000 again. So there's been a full cycle around freight. Chips are now back in supply, so you can buy cars again, apparently, or at least they're on the boats on the way down here. So we think there's some good signs on inflation coming down. Corporate top lines were generally strong, so that inflation pressure allowed people to put prices up. And so we saw, revenue was pretty strong across the economy. Unemployment is still very low in Australia, so even the retailers were trading pretty well. And so at the moment, we've all heard about this mortgage cliff that's coming down to terrify us all, but it's probably the most foreseen cliff I've ever heard of. And so to some extent, I think the bad news around the mortgage cliff is getting priced in by people's expectations at least. Companies are reluctant to give top-line guidance or at least outlooks for the year. That's not a surprise. I mean, whenever there's uncertainty, management teams take the opportunity to hold their hands up and say, we can't give you guidance. I don't think there's ever been a market where we've seen certainty, by the way, but whenever there's an excuse, companies like to not give guidance. And obviously, interest rates and balance sheets are now a topic of du jour. We have a preference for lowly geared companies for a whole bunch of reasons. They're safer. There's no need to come back to the marketplace at the wrong time in the cycle. But definitely low gearing is becoming more of an important asset for companies. And then finally, we're starting to see that some companies that are distressed or have been running off, sucking cash to run their businesses and now needing capital. And that's providing people like us with an opportunity to go back in there and recapitalize some companies if they are solid underlying companies.
And just on reporting season, what we have here is the top 10, bottom 10 movements for the month. It gives you some idea of the volatility that we saw during the month. It was crazy. It was a bit bizarre. There were moves there that were unexplainable. And, we think it's a bit in the small cap space. I think you've seen a lot of active managers leave the small cap space, and it's become much more inefficient. You've got, you've got algorithm-driven quant machines, you've got index funds, all playing havoc in the space at the moment. And you can see the volatility we had in the top 10, bottom 10. And like I said, some of it was just inexplicable. Like we just didn't know why prices moved so aggressively. In terms of the top 10 movements, we luckily had 3 in the top 10. We'll always take that. You never look a gift horse in the mouth. Link Holdings is one of our new investments, and so is Smart Group, which did well during the month. And Flight Centre, which we've had for some time. We bought Flight Centre pre the COVID downturn, and we recapitalised it at $7.50 with some other managers. But we had 3 good performers there. On the negative ledger, yeah, we had City Chic, which has hurt us in probably the last 6 months. We sold most of our holding out at $5 or $6. We'd owned it from, I think, 70 cents upwards. Unfortunately, we dialed back into it around $1.52, and it's fallen precipitously. The good thing about the company is they're going down the right path. They're unwinding too much inventory. They got too much inventory because I guess there were supply chain issues last year. They bought too much inventory ahead of their sales growth, and then sales declined. So they've kind of been caught in the pincer. But they're doing a good job now running down the inventory. I know it's a soft market out there, but the business is probably going to move into a cash balance sheet by the end of June. So yeah, we don't get everything right, and you can see all the mistakes in our performance numbers, which we'll present later. But this just gives you an idea of how much volatility there was. And I think Marcus will talk about some of the sectors next.
Yeah, thanks, Matt. So part of this presentation is to talk about sectors where we see opportunities and perhaps some risks in the small cap space. And if you've seen our presentations historically, we do occasionally do this where we drag up some stock names and talk about multiples and where we see interesting ideas and where we see potential risk. The one thing about small caps, which is always interesting for us, is there's such a myriad of players. I mean, there's some index funds, there's some active guys like us, a lot of retail investors, and the lack of liquidity drives extreme movements. So that might explain why we see big movements around reporting season, but also in terms of valuations, there's some really extreme examples and outliers there. So we'll talk a bit about our positioning later on in this presentation, but we are overweight consumer discretionary, which raises eyebrows. The reason being we're not a macro investor. Many people who can pontificate about the macro with great articulate, great eloquence, basically don't necessarily translate that down to really good bottom-up investing, and we think that we focus on the fundamentals and bottom-up. So we're overweight various sectors of the economy because we see better opportunities for our clients. One of them is consumer discretionary, and we've got a couple of stocks there that we currently have, Michael Hill, Universal Stores, AGI, where we see in aggregate they're on about 7 times EBIT. Each of those 3 stocks has a net cash balance sheet, and they're exposed to consumer in different ways, but it's very simplistic to say, the consumer's under pressure, therefore sell consumer discretionary. We're just trying to give you some examples as to why that may or may not be the case. And we contrast that with healthcare, which might be seen as a very defensive place to be. We're only highlighting a few stocks that are in healthcare, not the whole sector here, but a couple of stocks in healthcare, for example, that you might think are defensive, are in incredibly high multiples. So some of these stocks barely make money at the moment. Others make money, but on massive multiples. But we're not saying these are necessarily bad companies. We think Pro Medicus, for example, is a really sound business. We just find the multiple that you're paying for it in Australia pretty high relative to what we can find elsewhere. And we contrast that with some sectors like some names in technology are still burning cash. That was the flavour du jour, growth rates at any price. The market was funding those sort of names a couple of years ago with rates rising, cost of capital is rising, and obviously people want to see a return on their money, and those stock prices have fallen a long way. And in some cases here, we don't know if the unit economics are actually justifying a long-term business model or not. So we tend to avoid stocks like that where there's no business case we can find. And then lastly, the last bubble would flag in small caps is lithium. Now, Matt and I are not complete Neanderthals. We know that EVs are a thing. There's a massive drive to energy efficiency and to electric cars. But that furore around lithium demand has seen, firstly, the lithium price get up to levels that we thought was previously unsustainable, and the last month or so seen a big correction in lithium price. And many of the names in the small cap space that are not even producing yet are on extremely high multiples. Elon Musk, I think, is quoted as saying that there's software-like margins in lithium at the moment. And if you look at commodity stocks for a long period of time, they don't tend to exist for very long. So we do think there's a sort of correction eventually coming from supply in lithium that could correct those valuations. Now I'll talk a bit about how we're positioned, and Matt will talk about why that is the case.
Yeah, the interesting thing we've seen, and this is our small cap fund, and this is our weightings versus the sector. So our weightings are in the blue. You can see that we've been underweight energy, we've been underweight materials, which is resources, and we've been underweight financials, and that's been a dynamic for a while now. And that has hurt us, not owning some of those stocks. Some of those sectors have done really well over the last couple of years. And as Mark has said, we've been overweight consumer discretionary. And I think if you think about the consumer, and if you just invested on a macro basis, you probably wouldn't have any exposure to that. But as Mark has pointed out, that's where the value is. And often where the value is where you make the money. It's not what the macro influence or dynamic is looking like. And then if you look at consumer discretionary, I mean, it comes down to classification as well. I mean, InvoCare's our biggest holding in the fund. It's about 5% of that blue, and it's in consumer discretionary. Like InvoCare to us is the largest funeral home operator in the market. It's not discretionary, it's a staple. We don't understand the classification. But it just goes to show that a lot of these classifications are quite arbitrary. But we do think there's an opportunity in that consumer space, particularly companies that are well capitalised, that have a good product, have a good footprint. I mean, there's opportunity there. There's opportunity in the pain. And often people just shy away from pain. But pain is where you make money in the long term, I think, investing. So it has been a pretty tough 12 months in terms of the sector movements. I think there's been a bit of a reprieve in the last 6 months. The lithium bubble has started to burst. So we've clawed some performance back from that. And also the energy bubble is bursting at the moment as well. You've seen energy prices fall. So our performance has actually been good despite, I guess, not being in the right sectors in the last couple of years.
That's right, thanks Matt. And I guess we talk a bit about sector performance and within small caps, we've seen a pretty challenging environment, I guess, generally for smalls versus large cap. As most of you guys would know, probably having clients exposed to both large, international and small, there's been a real disparity in performance over the last 12 months. These lines just show the large cap index over the last 12 months, which has actually held up and risen over the period of time. And the small and micro cap indices are the blue and the light green index there, which you can see down roughly 17 to 20% between those two. What drives small cap underperformance or outperformance? I guess part of that is liquidity. Part of the fact that these companies are less diversified than large caps. I mean, BHP's in many countries, many minerals, etc. It's a large business. Small caps are exposed to one segment of the economy, and they tend to get thrown around a bit. And then I think liquidity might be another issue that tends to see small caps underperform when the market's under a bit of pressure. But it's not all bad news. When the market does turn, and we're not calling a bottom here yet, I was getting confident of a bottom until Silicon Valley Bank melted down on Friday. But when there is a bottom and people are getting more constructive about investing again, small caps actually are the place to be vis-a-vis large cap. These charts are a little noisy, but on the left-hand side there is the share price performance of the index performance over a period just around COVID, which all of us will have lived through. And you can see that the microcaps in particular, which is the light green line, got very heavily sold off as liquidity dried up and people panicked out of the marketplace during COVID. But they also had the most sharp recovery as we got, as the markets re-liquefied and investors became more constructive on investing in equities again. And they had a strong period of outperformance for the next 2 years. And then ditto during the GFC again, smalls and micros, did underperform going into that period of time. But from the bottom, or when there was a base formed in the marketplace, they materially outperformed. And if you look globally, we now run a global fund as well, so we do tend to look a bit globally. We've got 3 examples here, basically giving you the same evidence. .com was a different phase, because obviously the tech index, which was large cap again, was so overvalued going into March 2000 that it got really, really heavily oversold. But smalls and small caps definitely bounced off the bottom. GFC again in the middle there, which we saw the same kind of thing. Actually, GFC was interesting because the small caps didn't underperform by as much as you might expect vis-a-vis the large cap, but they had a really good recovery out of that. And I guess we say that when there is a bottom, there's a good chance to profit from a rotation into small caps. Part of the performance we've derived at Spheria is through takeovers, driven by the fact that we like cash flow companies. And the next chart just gives you a quick summary as to what we've seen in takeover land.
Yeah, so we presented this chart probably last year as well. So the average premium of takeovers in our funds over the last 6 or 7 years has been over 50%. I think we've had nearly 27 takeovers through the funds. We're not per se looking for takeovers, but it's the way we analyse the companies, I think lends itself to that. So we're looking at industry structure, we're looking at cash generation, and valuation is obviously very important to us. And clearly that's manifested in quite a number of takeovers at significant premiums, which has helped performance. I think if you look at recent times, we had Nitro in the last 6 months or so, and that was a very contested takeover. We had two parties bidding aggressively for that, and we extracted a very high price by voting down the scheme of arrangement, which we thought wasn't in the best interest of shareholders, which led to the counter bidder coming over the top. And so that premium, I think, relative to the undisturbed price was nearly 100%. So it just goes to show if you fight for what you believe in, you can make money out of these takeovers, and particularly in a contested situation like that. InvoCare is the most recent one, and what we've seen is we think InvoCare is a fantastic business. It's infrastructure-like, it's monopolistic, duopolistic in some regions, in different verticals. It's got the same competitive dynamics. It's one of the strongest players, we think one of the strongest businesses in the market, but it was never priced like that. And the reason it wasn't priced like that was because of, I guess, mismanagement, misexecution in the past. The current management team has been going through the process of investing in the business and fixing it up, and obviously it was subject to a takeover recently at a 40% premium. But we think there's more upside in that bid, and we're pushing hard for a higher price. And there's a once-in-a-lifetime type, no pun intended, once-in-a-lifetime type business. I mean, it's got, like I said, all these characteristics which are quite positive. So yeah, it's not something we look for directly, but it's something that definitely manifests in our performance numbers. And just on performance, and we've got these microcap and small cap funds since inception. You can see the microcap funds at the top there, and alpha since inception is 7%, and that's on a net basis after fees. Over 3 years, we've beat the index by 17% per annum, and 5 years by 7%. Our small fund has actually not done as well, but there's less volatility in that product. I mean, there's more volatility in the microcap space, I think, generally. The small cap fund has achieved its goals of, its goal is 3% outperformance in the long term, and it's done that since inception. And I think a lot of this comes back to discipline, doing the work, and also just having patience with positions. We've got a portfolio. Not everything's going to be going right at the same time in the portfolio. Things go wrong. But at the end of the day, I think we get a good outcome across our portfolios.
Yep, thanks, Matt. And then last slide here, second last slide. Again, we just summarised our opportunities fund, which goes up into the mid-50, down to micros and small caps. So it's a bit more liquid than the small cap funds. And then lastly, our global fund, which we've been running for 4 years now. So to give you a quick slight plug of that, which has seen very strong alpha over the 4 years. The team is now integrated, so we're doing global and domestic now as one team. But I guess the last thing that we're proud of is that the results have been achieved with lower than market volatility and beta. So we do focus on risk a lot with our portfolio construction, and the fact we buy good cash flow businesses. And so we're pleased with the fact we can derive alpha for our clients, but do it in a way that's less risky than the indices. So with that, we'll leave you with Warren Buffett's quote again about time arbitrage, and look forward to questions later on. Thank you.